less confidence in the forecast, less certainty about cash. Why this matters and why this matters now? Because the market is not rewarding noise. It is rewarding clarity. If revenues are lumpy, margins are unclear, and working capital is tightening, and then the board, the executive teams, and the founders still cannot explain what sits behind the fall, then growth starts to feel fragile. And that is when management teams get dragged into defending numbers instead of improving them. Now they want to exit, they want to sell. The numbers look very, very good until we look into the receivables, or actually the invoice unpaid, the collection portion of the company, 1.2 million they're sitting, and they say, where is that money? I say, oh, that is 2025, and we are hitting Q1 end 2026. They haven't collected 1.2 million from last year, and they don't know how to, right? So the question becomes this: if more revenue does not automatically mean safer growth, what does the board, executive teams, and founders need to measure and redesigned to make performance repeatable? And here's a keyword: performance repeatable. Okay? So if you want to boil it down to one word, is repeatability. First thing is separate revenue size from revenue quality. So the boards, executive teams, and founders need to ask where revenue comes from, often it recurs, and how concentrated it is. So how quickly it turns into cash, and what level of discounting or customers' work is hidden within it. So the board, executive teams, and founders should ask one blunt question: which assets are making revenue more predictable, and which ones are soaking up cash while pretending to be strategic? So if no one in the room can answer that clearly, board or the executive team or the founders is not steering capital, it is drifting through it. So if your forecast still leans on best case sales assumptions, delayed cost pains, or assets that are not generating sufficient returns, sooner or later the business loses credibility. But here's a challenge: if the board can see the weak spots in revenue, cash, and asset use, how do you bring in the right capability fast enough to fix them before the next half-year report?